Most investors are sleeping on a ticking time bomb. Some semiconductor stocks are trading under $5 right now. And history shows tiny chip stocks can explode 10x when the market cycle turns. Imagine buying NVIDIA when it was a penny stock. Today, I'm revealing 10 dirt-cheap semiconductor plays under $5 that could shock Wall Street this October 2025. Semiconductors are the backbone of everything. AI, EVs, smartphones, even military defense systems. And while the big names like NVIDIA, AMD, and Intel dominate the headlines, hidden gems are quietly sitting in the bargain bin, trading for less than the price of your morning coffee. These aren't random penny stocks. Each of these 10 companies is directly connected to the semiconductor world, from automotive chips to high-speed connectivity to optical sensors. Yes, they carry risk, but smart investors know that one small cap winner can change an entire portfolio. And the shocking part, almost nobody is talking about them right now. By the time CNBC or mainstream media wakes up, the opportunity could already be gone. If you love finding opportunities before the crowd, smash that like button right now. Let's aim for 500 likes on this video, and I'll drop a full deep dive analysis on the top 3 semiconductor penny stocks with the biggest breakout potential. Don't miss it. Your next 10x idea could be hiding in this list. Stock number 1 is Canaan. Canaan is best known as a designer of ASICs historically tied to crypto mining markets. But in recent years, the company has been trying to diversify into broader high-performance computing and AI-oriented hashing solutions. Financially, Canaan has shown deeply cyclical revenue patterns, with revenues spiking during crypto booms and compressing when mining profitability falls. Margins are thin, and the firm has a history of reporting net losses in many quarters as it invests in R&D and capacity. Recent quarters, as observed in public filings and earnings comments, emphasized cost control, inventory normalization, and efforts to secure non-crypto customers for its custom ASIC designs. Management commentary has highlighted partnerships for cloud and edge compute ASIC deployments, plus attempts to monetize IP licensing rather than purely selling miners. The main catalysts would be a renewed rally in crypto or meaningful traction in non-crypto ASIC design wins with hyperscalers or telecom customers. Key risks: revenue volatility tied to one end market, limited balance sheet resilience versus larger semiconductor peers, and the execution risk of pivoting from hardware volume sales to diversified licensing or bespoke design work. Investors should watch quarterly commentary on backlog, gross margin trends, and any announced multi-year contracts or OEM design-ins. If the company can demonstrate recurring licensing revenues or stable enterprise customers, upside could be significant from current low price levels. If not, the stock remains a speculative, highly leveraged play on crypto and ASIC cycles. Stock number 2 is GCT. Semiconductor, GCTS, positions itself as a fabless or small-cap semiconductor company focused on power management and specialty analog solutions aimed at power-sensitive markets. Historically, microcap firms like GCT show low revenue bases while investing heavily in product development and certification, resulting in operating losses in many reporting periods. Recent quarter commentary from similarly sized firms typically stresses design milestones, sample shipments to potential customers, and engineering validation phases rather than immediate revenue scale. GCT is likely the same: early commercial traction with pilot customers and small production orders. Financially, watch cash burn, R&D spend, and any convertible debt or equity raises that could dilute shareholders. These are common features for microcap chip makers progressing from prototype to production. Recent developments that would matter include announced reference designs for specific industries, automotive, industrial IoT, strategic distribution agreements, or foundry partnerships that accelerate ramp. Risks include thin liquidity in the stock, single customer concentration, long sales cycles for chip design wins, and potential delays in qualification. Positive outcomes would be timely design wins, improved gross margins through scale, and partnerships that validate the tech. For a speculative investor, GCT is a classic early-stage semiconductor bet. High downside if products fail to scale, but notable upside if a product becomes a standard in its niche. Stock number 3 is Valens Semiconductor. Valens Semiconductor focuses on high-speed connectivity ICs used in automotive and AV over IP markets, selling chips and IP that enable long-reach, high-bandwidth links for vehicles and professional AV systems. Companies operating in this niche typically show modest top-line growth that's lumpy, due to design win cycles with OEMs. Initial revenues often derive from evaluation modules and sample sales, with larger production ramps following multi-year qualification processes. Financial commentary commonly highlights accelerating design-ins with Tier 1 suppliers, improvements in gross margin as volumes rise, and investments in automotive-grade qualification and testing. Recent commercial developments to monitor would include new carmaker design wins, expanded partnerships with module makers, or inclusion in major infotainment or ADS platforms. Each could materially increase revenue visibility. Risks include long qualification times typical of automotive electronics, fierce competition from larger connectivity players, and reliance on a small set of large customers, which can lead to revenue concentration. Balance sheet health and any capital-raising activity are important signals of runway. If Valens can convert multiple design-ins into production volumes, revenue growth and margin expansion should follow. Absent that, the company remains vulnerable to seasonality and the capital intensity of automotive qualification cycles. Stock number 4 is EMCOR, operates in optical and compound semiconductor product segments, serving niches such as fiber optic communications, aerospace, defense, and specialized industrial photonics. Companies in this space often show revenue variability driven by project-based contracts, government procurement cycles, and capital equipment orders. Financially, EMCOR-type businesses often report thin but improving gross margins when moving from low-volume custom products to standardized modules, but they also face elevated R&D and capital expenditure needs. Recent operational focuses for such firms include expanding production capacity for photonics modules, securing long-term supply contracts with defense primes or telecom equipment manufacturers, and advancing technology nodes that reduce cost per unit. Catalysts would be multi-year contracts, certification wins for military or space applications, or large orders from telecom operators upgrading optical backhaul. Key risks are narrow end markets, long sales cycles, susceptibility to government budget shifts, and relatively low liquidity for investors. For speculative investors, positives include unique IP and defensible tech positions in high-barrier niches. Negatives include difficulty scaling quickly and dependence on few large customers. Stock number 5 is Axtaxt, is a supplier of compound and specialty wafers used as substrates for semiconductor device fabrication. Such companies are effectively upstream suppliers to chip makers. The business model is cyclical and tied closely to semiconductor capital expenditure. When fabs expand, substrate demand rises. When CapEx slows, revenues decline. Financially, wafer suppliers often show gross margin sensitivity to material costs and pricing power, with recent quarters typically highlighting backlog, book-to-bill ratios, and shifts in customer mix between high-margin specialty wafers and standard products. Recent corporate activity for firms like AXT includes facility expansions, supply agreements with foundries or IDM customers, and development of next-generation substrate materials tailored for power devices or GaN/SiC markets. Positive catalysts include broad industry capex cycles, growing demand for wide bandgap materials from EV and power electronics markets, and multi-year supply contracts.